Good morning. Welcome back to Mortgage Minute Live. We have a special guest today, not only with Tracy Lacerre with Hancock Whitney, we have the 5-time reigning, defending, undisputed heavyweight. Man, not heavyweight. He's not necessarily lightweight either, but I guess heavyweight.
It's been heavyweight lately.
We're going to go with heavyweight champion, times of Acadiana champion, Jeromy Bourque. Jeromy, thanks so much for joining us. I didn't do my best Bruce Buffer impersonation, but hopefully that'll work.
Just give me a cross field more often. Maybe I'll become. I
love it. I love it. So, man, one of the reasons that we wanted to have you here is there's a lot of questions on. We get the, hey man, I need to check with my CPA for about a lot of stuff.
And I tell a lot of people I'm not a CPA. Call your CPA for those questions.
Oh, that's fact. Robbie, I'm not a
CPA.
I'm not an attorney. I'm not, all that fun stuff. So now we've got the CPA here, and we got one of the best in the business. So we want to make sure, thanks again for joining us. So one of the first things that we talk about a good bit is, and this has been happening on a lot of files that we've had lately, gift funds, whether it comes with cash or equity.
Right. Yes. I called Jeromy yesterday and I said, hey, I have a past client who called me. He wants to buy a bigger house. They've outgrown their house. They want mom to move in with them. She's getting older. Mom has some cash. And mom doesn't want to be on the loan. She doesn't want to be responsible, but she wants to help with the purchase. Mom's got, $200,000 to $300,000 in cash that she wants to give, but the son said, hang on, mom, pump the brakes. I don't want you to have any major tax consequences. So can you talk to us about if someone were to gift cash money to a child, an adult child, to purchase a home, what does that look like?
Yeah, that one's a pretty easy one. Assume it's all cash, right? We're not selling any stocks, no other transactions happen. So you have your annual gift exemption, which is $18,000 or double $36,000 if you're married. So there's no consequences there. However, there's still no consequences if you gift up to $13.6 million. You have a lifetime gift exemption. So you have your lifetime gift exemption if you use it. So if you go over $18,000 in 1 year, you just need to report a gift tax return. It's just tax return filing. It's only informational purposes, so the IRS knows you've used up
keep track of
your lifetime exemption.
Right.
And you can go as long as this is just a form that goes on your tax return. So we're just chipping away at this 13.61 billion. And I don't think
actually a separate tax return. That's the only thing is it's a separate return filed, not like a form or a schedule attached to your individual tax return.
It's its own tax return.
Yeah. And even if you're married, it's 2 separate tax returns.
Gotcha.
Okay.
So it's like business, personal. Gift.
Most people think, oh my gosh, my parents going to give me $50,000 to buy this house. Because it's over the 18 annual limit per person, they're worried that they're going to, mom or dad are going to have some tax consequences as a result. And that's not the case because there's a really big lifetime.
Right. I usually ask them, what's your parents' estate look like? Is it over 100 million? What's that look like? Is it really going to be truly any, consequences? And most people, here in Lafayette, Louisiana are going to say, oh no, we're good. We might have $1 million.
We're not going to hit that. Yeah. Okay. Well, that makes me feel better. That annual gift also typically increases year over year, right?
Yeah, that one actually does pretty often compared to other, tax credits or deductions.
Right. And it's per person.
Correct.
Right. Yeah. So if
say what that really means to everybody.
That's what I was going to do. So if there's a mom and a dad and they want to give to a son and a daughter-in-law, it's 18, 18, 18, 18, right?
18, 18.
18, 18. Okay. Got it. I think that's another
13.6,
Right.
7.2, yeah.
Okay. So another form of gift that we deal with often are gifts of equity. In other words, I have a great scenario last week that I closed. Dad inherited a property from his parents. His son, the grandson, has been living in the property and they're ready for him to purchase the property from dad, who got it via succession. Now, I always do a thorough interview of my clients. And when I talked with them, I knew that dad inherited the property and son has been living in it. There was a small payoff that dad wanted to take care of, and dad wanted to get a little money back to help son renovate the property later. And we also wanted son to get homestead exemption. We wanted him to have a mortgage on his credit to help establish a really good trade line on his credit report. And then doing the gift of equity, for such a large sum allowed us to roll in all the closing costs. Son came with $0. And there was so much equity that it negated the need for PMI, which also saved money. So it checks so many boxes for this guy. I'm like, gosh, a gift of equity makes so much sense because it helps everyone. Can you talk to us about that? And also, if it's ever a situation where the property wasn't inherited, what the consequences could look like from a taxation standpoint?
Well, I'm going to sound like my therapist right now and just say there's a lot to unpack there. So let's start with kind of like a simple situation, right? So like with inheriting property, a lot of people might know that, if your parents pass away and you receive, their real estate property, right? Or even stock, your basis in that, and we'll talk about basis in a second, is stepped up to the fair market value on the date of death. So, if it's an easy situation like that, you have that step up in basis. If you sell the house in the future, your sales price will go against the fair market value. When you gift property to someone, it actually carries at the parents or the person gifting the property, their basis. So, and not your situation, with the parent receiving property from a grandparent. Let's just stick with just the parent. Mm-hmm. If they purchased that property, for $20,000, years and years ago, and is now worth $500,000. A lot of times we'll probably dig a little bit deeper in, what's their plans for the property. They're staying in it long-term, lifetime, because if parent purchased that property for, let's just say $20,000, it's worth $500,000 a day, and they gifted it to the child or half of it. Again, it's just more complicated than the numbers. So you get your step up in basis on half of it, but not the other half. So in the future, when you sell it, you can still have some capital gains, at that point in time. In your situation, the property was inherited and then gifted. So it was inherited at that stepped up fair market value and gifted, at that fair market value too. So that's a pretty good situation when that happens. I don't see that as much as you, obviously. Every once in a while, we get the gifted, this straight inherited property, but never the gift of equity. Usually when I'm dealing with gift of equity, it's from the business side. It's like,
right.
I'll be giving his, business to the kids or something like that.
So if you were to put some numbers on it, on the situation where the property wasn't inherited, then gifted, if it was just like, hey, mom owns this property, daughter's going to buy it for, property's valued at $200,000, mom is going to gift it for $100,000. Gift $100,000 in equity, and daughter's going to do $100,000 loan. Like, what does that look like?
That would probably be a situation where it should be fine, right? That's gonna be one where that's small dollars. I'm not gonna, sway you another way with that, because a house that's worth $200,000 today, it's not gonna be worth, $600,000, $700,000 in the next 20 years, right?
Yeah, these houses that we do these gifts of equity on typically aren't $500,000 houses. These are $200,000 houses.
Yeah. And what I mean there is that, you have your annual exemption from when you sell your personal residence, $250,000 or $500,000 if you're married. So again, if you're selling it for anything, more than that, you have some tax consequences, but very unlikely in that situation.
Right. That's a rare case where you have that bigger price point where that happens. Yeah. For the almost 18 years I've been doing this, I don't think I've ever seen anything over $200,000 in that.
No, usually it's like land, some land that really skyrocketed.
Yeah. Yeah, for sure. Is there any documentation that you would tell both of those parties to keep so that they can pass on to their CPA when they file taxes?
I would tell them that Tracy's going to require it anyway for the file. They're going to require some kind of letter or something, from the parent stating they're gifting, those equity or whatever, what it's worth.
Yeah. And then whenever they go to file taxes, both parties, is there anything that a CPA would ask for, like especially from the parent who transferred the property or sold the property?
Yeah. So a lot of times, like, taxpayers will think, we'll notice a new 1098 mortgage interest form, right, with a new address. Like, oh, did you sell your house? Yeah, but it's not taxable, right? But you still have to report that sale, even though it's not taxable, right? And a lot of times the title attorneys are filing a 1099-S, which reports the sale. So whether you do it or not, the IRS does know about it. You want to report the cost basis to make sure you report that it's not taxable, that you've owned it for 2 to 5 years, all that jazz, right?
We need to know that you no longer own that property.
Yeah, absolutely.
Yeah. Okay. Do you want to get into self-employed?
Yeah. So getting into self-employed go ahead.
Okay. So self-employed borrowers. So what's good?
I think we're
going to do the other one? Okay.
Yeah. No, we could talk about self-employed.
So,
we'll do that. I want to do that last because that's kind of filtering out and giving them do something else. Let's jump into while we're talking about like deferring some taxes, 1031 exchanges. What are they? Kind of baseline what it is and why people use them.
Okay. So a 1031 exchange, very commonly referred to as a like-kind exchange. And I point that out because a lot of people will come to me thinking they can, sell their rental property and buy a personal home. There's no tax consequences there, or you can defer that gain. But remember, it's called a like-kind exchange. So you want to trade property for like property. So a residential rental for a residential rental, not residential rental for a commercial rental. It has to be very much like-kind property. But you can potentially postpone taxes. It's not, kicking taxes out the door forever on a property you're selling, but you can defer it until the next sale, or you can continue doing 1031 exchanges, right?
But that property has to be identified. That new property has to be identified within a window of time.
45 days, yes.
Right.
And then the sale has to occur within 180 days of the sale of the first property.
It doesn't have to be in the same calendar year. So, for example, if you sell in December and you buy in January, February, that's acceptable. Yeah. That's another common question I get.
A key factor I get, and probably what I find that, majority of people who ask this question don't go through a 1031 exchange because they have to use a qualified intermediary to handle the transaction. Usually a broker, for example. I don't know if who you guys use. Usually use like CPA. Okay. Usually use like certain like title attorneys that will do that work, but it's coming less referral sources that I have for that.
Yeah. Got it.
Perfect. So, and just to kind of recapture, single family rental or, multifamily rental for multifamily rental, or income producing rental, not I can't turn around and buy an office building, and would a rental couldn't be like a vacation property either. So if I sold a rental property that was one tenant for X number of years, turn around and bought a camp or condo at the beach or whatever.
Unless you're going to rent it out.
Unless you're going to rent it out.
Correct. You'd have to rent it out.
Right. Yeah.
So that's similar because it's rental, family.
Like property.
Correct.
Yep.
So it doesn't have to be, I guess what I was getting at is it doesn't have to be like kind isn't like exactly like
footprint. Square footage.
Yeah. Correct. Yeah. No, it's more like the type of property, whether it's, whether it's personal or residential, residential or commercial.
Same classification, I guess, is it better? Yeah, there you
go. Any common misconceptions, like glaring misconceptions that you get about 1031s?
Yeah, taxes go away forever. It's just a deferment. It's kicking the can down the road, as I say. And sometimes I'll push for it, right? If, I got a business owner who has, 2 or 3 businesses and some rental properties and some investment properties, right? And they've had a great year, in for instance, during COVID, some businesses did pretty well because of the demand for their services. Well, and at the same time, they want to sell a property. I would probably push for that 1031 exchange because your income level is so high this year, and it'll probably tell off.
Normally high.
Push it to that year, right?
And it will likely decline in future years after, right? Yes.
Or you can offset it with a capital loss somewhere else.
Correct. Yeah. So it's all about planning for that long-term strategy.
Right.
Gotcha.
Okay.
So speaking of rental property, I want to kind of stay on that topic. Another one that I get a good bit about is depreciation with rental properties. What's it for, and why do we use it?
I've got some very intelligent clients that make good money, right? And I get questions every year from them on depreciation, the same questions, honestly. and I try my best. I pride myself on educating, my clients, but it's very sticky subject. But depreciation is basically capturing the cost of purchasing the property over its useful life. So for residential rentals, it's 27 and a half years. Commercial rentals is 39 years. You get to deduct that on your tax return against, any income from that property as well as other expenses, right? But when you sell a property, that depreciation will be recaptured as ordinary income, when normally when you sell property, you pay capital gains tax right now at 15% starting out. So
gotcha.
That one always frustrates people. Why do we depreciate? It's like, well, we get a depreciation deduction in years, 1 through 10, and we sell it in year 10. We'll have to pick that back up as ordinary income versus capital income.
And from a mortgage standpoint, typically you can add depreciation back into income. So if you plan on buying a property in the near future, you can typically add that back. So it's helpful.
Yeah, and I'll also say if you're buying a rental or even building a rental, having the I guess cost segregation, if I get into that topic a little bit, or at least having the details on what the costs were that went into that property or any like renovations will really impact what you can depreciate the first year. So if you remember, for a residential property, it's 27.5 years of depreciation. However, like the cabinets in that house, we can depreciate that, over 7 years or even immediately, depending on what the current rules are for bonus depreciation that year.
Oh.
So just making sure that I'm understanding this too.
Yeah.
From the CPA side, somebody would want to depreciate to be able to reduce their gross income that they're reporting over to the IRS, potentially to either drop down brackets, help them drop down brackets. So having those rental properties, being able to go and use some of those expenses to be able to go and renovate and upgrade and all that other fun stuff, which would help them in the long run on their taxes. Now, they've just got to have a plan in place with their CPA. Hopefully it's Jeromy that, if there is any plans on selling any of these, what this happens to look like, not just on an immediate, but a long-term strategy on if you're planning on offloading some of these items, right?
Definitely. Yeah. And it matters too. Like, for you guys are considered from the IRS standpoint, you guys are real estate professionals, right? So, if you have, let's just say $100,000 in salaries, right? And you've got a bunch of new rental properties where you're taking advantage of some of this cost segregation, depreciation tactics we use in tax planning, you guys can reduce your salaries, the taxable income of your salaries by that amount. However, if you're a 9-to-5 person with one rental property, you would be considered a passive investor. And those losses in that year, just say 2024, would actually be limited to zero. So like you report zero for any income on rentals, but you can't reduce your salaries.
Mm-hmm.
But that loss will carry forward into future years. And a lot of times when people, want to buy rentals, they're thinking tax breaks today. I want them right now, right? And a lot of times they're more thankful that this does happen for them, because in the future, when they sell that property, all those carryover losses can be captured in that year. Most of the time they're selling it, they're walking away with $100,000 and no tax implications. So then they're a little bit more appreciative of that little rule there.
It's definitely a long-term game.
Yes, it's an absolute long-term game. It's not a short year thing,
Yeah.
I tell people, look at your rental properties as your 401k. Don't touch it,
Unless you're flipping, if you're truly investing in rental, like it's not to, buy, sell, buy, sell, buy, sell. That's what a flip is, agreed. Okay. So speaking of tax returns, can I talk about
Yes. So one of our favorite things that pop up, somebody that makes a ton of money, typically 1099, self-employed, makes their own thing. They've got a ninja CPA that is so good at working through those taxes. However, if you don't show enough income, then you can't.
So if you're self-employed, if you're self-employed and you show a very low net income or even a negative, which is possible, it does make it difficult for your loan officer to qualify you for mortgage transactions. Some items, like we said before, can be added back. Things like depreciation, mileage, or even like if you have a Schedule E, I'm going to get real in the weeds. If you have rental property and you file a Schedule E like you're supposed to, not everybody does. But if you do, and let's say you have a large, big ticket item that you did for the year, i.e. a roof, HVAC replacement, something that you're not going to do year over year with the property, with proper receipt, I can actually add that back into income, because that's not going to happen again and again and again. That's not an expense you're going to incur. You're not going to replace the HVAC every year. At least I hope not. So that can be added back into income. There are a lot of things that can be added back, business use of home, things like that. But if you tell me, hey, my gross receipts were $500,000 and I paid $400,000 to run my business. Well, that tells me you needed to spend that $400,000 to run your business to earn the $500,000. So that leaves you with $100,000.
Right.
And that's not going to fly when you're trying to buy this $1 million property.
Yeah, absolutely.
So,
I mean, I'll praise you for sure, first off, and say, like, you're way better at working with clients on that stuff. I've had to explain and even fight for some clients. Like, no, this is we call them in the ordinary expenses or normalizing items, right? They're not always going to have that HVAC system that needed this year, or, they just implemented a software. It was $1 million piece of software, right? We're paying it over the next 10 years, but it's a huge impact to them right now that's really not going to carry forward to the future. So things like that, you definitely need to work with, your mortgage, broker. And secondly, you need to work with your tax person. Assuming it's not me, right? It's another CPA or it's H&R Block. They don't know that you're going to buy a property in the next, 2 to 5 years, right? Or even just 2 years.
Right.
So, that for the individual standpoint, you definitely need to let your person know that, hey, maybe tax planning is not a priority for this next 18 months. I want to get approved for some financing for a new property or, whatever it may be you need. So it's a little bit of a seesaw effect, right? You're going to probably pay a little bit more taxes. We're not going to get aggressive with the tax planning. But again, we'll carry some of those things over into the future years when you don't need that financing.
Right. So I would say if you plan on buying a property, whether it be personal or investment or whatever, within the next, like you said, 3 to 5 years, let your CPA know. And I know you said earlier before we got on the live that that's something that you ask your clients. You plan before we file aggressively.
Yeah,
you plan on buying a property.
Here's what's going to happen
in the next 3 to 5 years. And look, every file is different, right? It's just like a fingerprint. No file is like any other file for me. So I could have to look as far back as 3 years because we're already at the end of 2024. So I may have to look at a 2024 P&L, plus 2023 tax returns, plus 2022 tax returns. Or it could be as short as 12 months, depending on how long you've owned the business, how profitable it's been, what all your numbers look like. So for me, anywhere from 12 to 36 months is the window of time I have to look in. I always err on the side of caution and tell my clients 36 months because that's a worst case. I'd rather overestimate than underestimate. And if behind the scenes I can pull off 12 months and their income is higher, then great. We did it. Path of least resistance, right? But I would say 36 months is a good time period to prepare for.
And that's kind of why I always, our philosophy in my firm is if you're a business owner, we're likely filing an extension and we're going to probably, wait to file a return later in the summer because of things like this will come up, right? And they might have planned to buy a property, but hey, kid number 4 is on the way. This house is too small now, right?
Yeah.
A little bit of the tax plan. We have that leeway of an extension to make any changes to the return to either, reduce taxable income or increase it if we're being aggressive with some tax planning that we don't need to anymore.
Yeah.
That's perfect.
Very good.
Oh man, we covered a ton of stuff and I know we could have gotten even
we could talk all day
further into the weeds.
Do it all day and you'll go sleep all day.
You'd have everybody up here. Well, Jeromy, thanks so much for joining us, man. Where can they find you if they're if they're in the middle of, shopping for a CPA? Maybe they found out somebody that, they need to go after the reigning defending champ. So where can they find you?
They can find us on all social media, Jeromy Bourque CPA, jbourquecpa.com, or they can give us a call, 337-362-5005.
Thanks so much for joining us.
Tell Emily we said hi.
We'll see you guys next week.
Bye.
Bye, guys.